that's not quite true. What they're actually saying is that there are two completely separate agreements. I call it splitting the atom. Okay. What happens is, who created your loan? You? No. Well, the bank, with whose help? Yes. You instruct the bank to create money out of thin air. Congratulations, that's the end of transaction one. That's all there is. But the bank knows that you don't understand this. So what they say is, why don't we go into a separate agreement, completely separate agreement, whereby you promise to pay it back. When I say paying it back, what I'm referring to is a stream of regular monthly repayments. So it's split. Now, the security that you put down for your house had nothing to do with this loan, the money that you created, right? It is to make sure that you perform on your monthly obligations.
So what's the second transaction?
First transaction, you create the money, assets, liabilities. Second transaction, stream of regular repayments. They are completely separate. The stream of repayments that you're making every month to your bank has got nothing to do with the way the money was created. You only think it does. Because credit, the word credit comes from the Latin. Forgive me if my Latin is not very good. Anyone? I believe, correct. The word credit comes from Latin meaning I believe. It's all in your mind. Remember, there's nothing physical backing it. So, because you believe, so it is. Now, who can tell me, what is the number one rule of banking? Ask banks, what do they have to do to maintain an economy at all costs? Make believe, yes. What's the word, though, that they love using? They have to keep it in the economy. What is it? What's that? Confidence. The number one, even conventional bankers, economists will tell you this. Our number one role is to keep confidence in the system. Heard that before. Under all costs, tell them what they need to know. Focus on rugby and beer and wine. Everything is fine. Don't worry about it. We are taking care of it. Confidence, confidence, confidence. Guys have heard of Yanni Rousseau? Yanni Rousseau. He wrote... sorry, let me back where this is here. South African, I think he was head of Reserve Bank at one star. Yanni Rousseau says, in the South African Reserve Bank, history, functions and institutional structure. He says, the maintenance of public confidence in the stability of the banking system is the cornerstone of the process of financial intermediation. The maintenance of public confidence in the stability of the banking system is the cornerstone of the process of financial intermediation. The cornerstone of financial intermediation. Confidence is everything. That is their goal. Maintain confidence. You saw what he said. What is it? 17 pounds for every 1,000 pounds? In other words, there's only 17,000 actual pounds sitting in your account for every 1,000 pounds of money. So if there's a run on the bank like Northern Rock, there's a run on the bank, it collapses. So what happens is if people just don't have confidence, we got a problem. That is why their PR, their media, everything is geared around confidence. They will say anything that is necessary. The maintenance of public confidence is in the stability of the banking system is the cornerstone of the process of financial intermediation. Remember that word, intermediation. I'm going to come back to it later. The emergence of liquidity or solvency problems in a particular bank can threaten confidence. Not only in that particular bank, but also because of the possibility of contagion in the safety and stability of the system as a whole. Confidence, confidence, confidence. Now, let's have a look at what I think it's Angela Merkel says. Only a banker could say that. Rejoice says, the Greek citizens have done the right thing. The European Union is going to help Greece because the European Union is and must be a joint project that seeks the well-being and the material improvement of all European citizens. Before the latest Greek results came, Christina Lagarde, head of the International Monetary Fund, was grim-faced as she addressed the B20 meeting of world business. So clearly she's not so happy. She addressed the meeting of world business leaders running up to Monday's G20. She beseeched the businessmen to exert their influence and pressure world leaders to address the mission-critical priority of, restoring investor confidence in the world economy. Be as blunt as you can with the G20 leaders, she said. Prioritize and indicate what, in your view, in the view of the investors around the world, it is critical as far as you're concerned to restore confidence. That is what everything ultimately comes down to. It comes down to restoring confidence. Meanwhile, what else is happening in the news? Americans saw, this is in the last 10 days, Americans saw wealth plummet 40% from 27 to 2010. Federal Reserve says Spain faces total emergency as fear grips markets. Italy to sell 10 billion assets to cut debt and pay bills. What are they going to sell? The gladiator with, what do you call it, the Colosseum? I mean, you're just handing assets over to these people. China manufacturing contracts for 8th month. Spanish banks need up to 62 billion to withstand economic shocks. And very recently, Moody's slashes credit rating of Britain's biggest banks. And I think there were 18 of them that have been slashed again. This is par for the week, guys. It's really nothing fancy. It happens all the time.
The Germans are freaking out about having to bail these countries out. The German people themselves are taking them down.
Yeah, I want to show you this notion about confidence and how it's all about belief. It's all in the mind. This is what we're doing. It's an entire mental prison that's been created specifically to lock us into a system that doesn't actually exist. But I want to go back to that word. I want to talk about the word instrument as well. And I'm going to talk about how that actually works in a minute. But before I do, let me just finish off reading this. Okay. Again, harp on this. Banks do not take security for loans and mortgages. The credit beneficiary or nominal borrower pledges his own security as a guarantee of his performance. In other words, a security for his payment obligations, not as a security for the credit or loan granted by the bank. Now, remember what it says here? Technically, this is extremely important from the bank's perspective. Why? Why not just have one agreement that says money gets loaned and then we pay it back? Why do they have to be split? And the answer to that question is they have to be split because what will happen is if it's split, you now have a very clean stream of monthly repayments coming in that have nothing to do for a loan, right? That is now an asset that the banks can now trade with on the securities and derivatives market. You're going to hear words like securitization. You're going to hear words like collateralized debt obligations, CDOs. You're going to hear about things like CDOs squared and CDOs cubed. Yeah. CA25. What is it again? That's handy, sitting right by the door. Okay. So you see what's happening. When you go for a loan, it's not just an ordinary agreement that we've been led to believe. It's split. So now that these separate payments are going, so you're going to hear about securitization, because securitization is incredibly important to understand. And what I'm going to do is I'm going to carry on reading this and I'm going to show you something else. Because, yes, in essence, yes.
One's a cash flow stream and another one is actual liability.
Yes, that's right. Yeah. That's what our research leads us to believe. Has to be. There's no other way of doing it. Because remember, when we think when we say I'm going to transfer from one account to the another, there's no actual transfer account, isn't there? What you're actually doing is you're instructing the bank to destroy the money in this account and reappear it in another account. I'm going to show you how that works just now when we start talking about how checks work. And actually you instruct the bank to create money out of nothing. We are instructing the banks to create that money. So you're not transferring money from one account to another. You're literally instructing the bank to destroy money here and create money here. Isn't there a whole new age thing going that we are the creators of our own destiny? We are literally creating it. Quick question?
Just one thing is, are we going to get copies of those notes?
Yes, I'm going to make everything that's going to be available to take.
Second question is, why don't we start our own bank?
Start our own bank. Yeah, it's the moment you start taking deposits, the moment that you start taking deposits, you get, yeah, black helicopters start circling. Okay, so are we clear? We've now gone through point 1 of 16. Are we happy with point 1? Banks do not loan money as their prolific advertisements claim. Money loaned is actually money created via an elaborate scheme of paper shifting and number crunching. It can be said that banks make money out of thin air under the pretense of a loan, but in reality it is not a loan at all. This is deceptive and misleading, as very few South Africans know the truth. Point number 2. It is a common legal principle in our law that one must possess that which one loans. Duh. Remember I said just now, remember the line financial intermediary? Remember that? I said remember that word? Okay, I'm going to come back to that. It is a common legal principle in our law that one must possess that which one loans. For reasons above, in other words, the banks make money out of nothing, banks are unable to meet this, a fundamental criteria for a valid borrower-lender contract. In fact, banks are actively and blatantly breaching the Home Loan and Mortgage Disclosure Act. It's worth having a look at the Home Loan and Mortgage Disclosure Act. It's about 5 pages long, and it's a death blow to the banks, one of the many. I won't go into that in detail now. But what I do want to show you is I want to talk about this borrower-lender contract, and that you must loan that which you possess. Now, as Yanni Rousseau said, banks undertake a role of financial intermediary. Okay? What is an intermediary? Exactly, it's a go-between. How many of you are estate agents or act as an agent? Does anyone work as an agent? Someone's got their hand up there. Are you an estate agent? Okay. Are there certain rules about what you have to disclose to customers as an agent and your commissions?
Yeah, well, it's very murky because according to the board, there is.
Do banks discuss their commission rate with you? Why not? They don't even disclose that they're acting as an intermediary. Do you see what's happening? You have to disclose as an intermediary. So essentially, let me just read you again here. The New Economic Rights Alliance got a lovely letter from Advocate Blackbeard at the South African Registrar of Banks, which is part of the Reserve Bank.
Is his name really Blackbeard?
Yeah, his name is Blackbeard.
It's probably a blonde, isn't it?
Yeah. Interesting. As you may be aware, banks take deposits as a regular feature of their business, thereby fulfilling an intermediary role in the economy between lenders and borrowers. Now, it's interesting because he shows that they're acting as an intermediary. And in South African law, anything that involves an agency relationship must be disclosed up front. You can't lend something to someone if you don't own it. If you're acting as a third-party intermediary, you have to disclose it. And there's certain laws and regulations like the commission structures and all that have got to take place. So banks aren't doing that. I find it very interesting, though, is whether or not, where he says that banks take deposits as a regular feature of their business, thereby fulfilling an intermediary role between lenders and borrowers. Does he also think that lenders, the intermediary role, does he also think that banks actually lend money from their depositors? Because I hope I've proven to you now that that's not the case. Okay, good. So you're starting to see what's happening with the intermediary role. Right. Time for our next video.
Scam on earth. Thomas Jefferson said, I believe that banking institutions are more dangerous to our liberties than standing armies. If the American people ever allow private banks to control the issue of their currency, the banks will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. Jefferson's warning is already here. 40 million Americans are living on food stamps. Millions more are now homeless, living in tents, all because of one institution, the Federal Reserve System. The Federal Reserve is a group of private bankers who have stolen the money creation process from the American people. Most people still believe the Fed is an agency of the government working in our best interests. It is not. There is no greater form of evil in the world today, so let's explore the banking scam. None of us have ever been taught anything about money. The reason is to prevent us from learning the truth that money is a trick and money is a trap. When solving any crime, there's a universal truth: follow the money, but with the banking scam, follow it backwards. Where does money come from? The world's money supply is always growing. Where does all the new money keep coming from? Money comes from privately controlled global banks like the Federal Reserve System. They create money every day, which increases the world's money supply. Because all banks are either owned or controlled by private bankers, the real question is, how do private bankers create new money? And the answer is, they create it out of thin air. Bankers create money out of nothing. They make it up. It is a fiction. Wow. Godlike power to create something of value out of nothing. A stroke of a keyboard and money is created. In fact, only 3% of the world's money is even in the form of bills and coins, which means 97% of all money in the world is just numbers typed on a computer screen. This is part one of the banking scam. Money is created out of nothing. The second part of the scam is this phony money is issued as debt. What is debt exactly? Well, when you consider we work our whole lives to pay it off, you could say debt is slavery. But whose debt is this phony money? It's our debt, all of it. It's our debt when we use credit cards, we get student loans, borrow money for mortgages, all bank borrowing. And it's our debt, again, when the government borrows, which is each and every day. In today's world, money is debt, and debt is money, and don't forget the interest charges. Money equals debt, and debt equals slavery. Therefore, money equals slavery. Our monetary system is a carefully concealed system of slavery. Why? Because our government can create the same money for free with no interest charges, just like they used to, as the Founding Fathers designed it inside the United States Constitution for our protection against private bankers. The third part of the banking scam is very evil. When bankers create money from nothing and issue it as debt, they only create the principal portion of the debt. They do not create the money for the future interest payments. There is not enough money in existence for all of us to make our interest payments. In fact, our money creation system is even mathematically impossible. Money issued by the banks, principal debt, does not equal the money demanded back to the banks, principal plus interest. We are forced to play a game of musical chairs to see who can make their debt repayments. This guarantees a world of bankruptcy, competition, and scarcity of money. For example, we go to the bank to borrow money for a house, let's say $100,000. The moment we sign the loan document, the bank creates the money out of thin air. A $100,000 debit gets registered for us and a $100,000 secured credit for them. Then one of two things happens. Either we give the bank 30 years of labor making house payments totaling $300,000 for the original $100,000 we borrowed, or the bank takes our house. The bankers get either our labor for life or our house, and often they get both, all from money created out of thin air and issued as debt, for money made out of nothing. This is why all the bankers end up with all the assets. The fourth part of the banking scam is inflation. People think inflation is prices and costs increase. A better answer might be the value of our money always goes down. Inflation is created every time the central banks print money, which is every day. Where does all this new money get its value? The answer is, it steals its value from the existing money supply, where our savings are. Our savings are disappearing because of the new money they're printing. If money creation was in balance with goods and services, there would be no inflation. Prices would stay the same. But the reality is banks always print money, driving prices ever higher, which steals the value of our savings, making them disappear. Since the private bankers created the private Federal Reserve in 1913, the United States dollar has lost 97 cents in purchasing power. An item in 1913 that cost $100 in 2011 cost $2,230, a price increase of 2,130%.
Okay. So now we see this word intermediary. So what they're actually doing is they're acting as an intermediary. and they act in other words, the banks are acting as an intermediary or agent between the customer and other parties. Now, I'm going to show you why this is going to be relevant when we talk about securitization, because remember that we created our own money, okay? So, essentially what is happening is the Reserve Bank, because it also plays a role, and I really don't want to go into too much detail about the Reserve Bank today, but essentially the pretext is that banks loan money from the Reserve Bank, because they couldn't without the existing of the Reserve Bank now anyway. But commercial banks is where the money actually gets created. However, there's still an intermediary role that occurs between the customer and the Reserve Bank. However, it's really within the securitization model where they actually get money from third parties, where this becomes more important. But the banks are acting as an intermediary or agent between the customer and other parties. It is a requirement that an agency relationship be disclosed up front to the customer. Banks do not disclose this relationship, and as a result, most people are under the complete illusion that they are borrowing money from the bank in the ordinary sense of the word. In fact, that banks are unable to show that a default actually occurs them any financial loss. And that's again, how many people are out there, guys, that are already struggling to pay the bank back because they grew up believing that one should pay their debts, that the bank is suffering a loss, that it's going to hurt the economy if they don't pay it back. If the banks get hurt, the country's going to get hurt. How many people are under that illusion?
Not till now.
Banks are failing to provide simple information to their customers that should be easy to access. Examples include a certificate of balance, audited proof that a lawful deposit was actually made, and the physical location of original documents, promissory notes, and other negotiable instruments. Instead of providing the customer with this information, they choose to take legal action and foreclose on homes and assets with remarkable alacrity. Okay, so there was a lady that came up to me earlier who was fantastic. Who actually got hold of her bank. How many of you guys have actually contacted your bank?
They won't give me what I asked for.
They won't give you what you asked for. Who's been through that? Put up your hand if you've talked to your bank and asked them. Did the bank, what did they disclose to you?
Nothing.
Why do you even ask?
You go to your bank and you say to them, can you please just prove to me that there was an actual loan that took place? Just prove to me that there was a transaction, that money went from one account into the account that was created for me as a loan. Simple question. What do they get back to you with? Dear Mr. Smith.
There's the banking ombudsman's number.
The bank, oh yeah, if you have a problem, then go to the banking ombudsman. Yeah, Mr. Pillay. Dear Mr. Smith, we can confirm that a legitimate credit agreement is in place, and that the credit was extended to you. Should you breach any of these terms, we will be required to take legal action against you. No, and you go back to them. You didn't hear the question. What I want to know is, did a lawful deposit take place as per the Banks Act requiring and transfer and liquidity and GOV and all the things that you're supposed to comply with? Was money actually moved? Because you used the word loan, so I expect money was loaned to me. Can you just prove to me that a loan took place? We hereby are instructed not to deal with you anymore because we do not wish to litigate via correspondence. We would prefer to litigate via the courts. If you take an issue, we will be passing this over to our collections agent. We believe we have a lawfully binding agreement in place, and we can confirm that the credit facility was made available to you. What did John McEnroe say? Answer the question, jerk! They won't answer it. That's what I did when I first discovered this. The first thing I did was ask my bank. It's fascinating to watch them. So we start to see what is going on. Right. Point 5. Banks engage in a widespread and common practice called securitization. Instead of borrowing from the Reserve Bank on our behalf, banks bundle many loans together and then sell these bundles to investors, whereby our loans become securities. Now, just to give you guys an idea, when a loan becomes a security or a securitization of anything of an asset occurs, it's a bit like this. You take a glass of fresh water, right? And that's a loan or a stream of repayments that are coming in. If you securitize that, it's like taking that glass of fresh water and throwing it into a fish pond with a whole lot of other loans. It's now been securitized. You can't then go back and take a glass of water from that, bring it back and go, oh, yeah, we have an agreement. It's not the same anymore. It's now been pooled. Okay. This is essentially how the securitization works. Did you want to mention something?
Scott, just the term you have used again is that you talk about a loan, and in fact what you've described is that the loan is the first part of the agreement. It's the second part of the agreement that is being used in securitization. So in fact it's not a loan, it's not legitimate in that sense.
Correct.
It's my it's my promise to repay that they are then trading further.
Actually, yeah, it's a good question if it's even the promise to repay or if it's not just the monthly stream. It's also an interesting point, but yes, it's a promissory note that gets transferred. Just what he's saying is, again, it goes back to splitting the atom that I talked about earlier. Remember, the creation money process is separate to the stream of constant repayments. This is what is now being sold into the third parties. Okay, so the bank is now getting their money up front. So not only have the banks not suffered a loss, they've made a huge profit. And they go to court and go, we've been hurt. He's not paying us. We need to take his house, my lord. That's what they call judges. I don't know if you guys have ever been to court. I mean, if you guys go to court, you basically have predominantly men wearing black robes, okay, men wearing black cloaks, okay, robes, bowing and praying, P-R-A-Y, literally praying for judgment from a man that sits in a chair above them who they call my lord. If that's not enough to start just getting the brain cells just not computing properly, I don't know what is. Maybe we can talk a bit more about that in the second session. Right, so banks engage in a widespread and common practice called securitization. Instead of borrowing from the Reserve Bank, banks bundle many loans together, or in this case they take the future monthly repayments, bundle all the future repayments together, and sell these bundles to investors, whereby our loans become securities. When they become securities, fresh water into the pond, you can no longer get that fresh water back. These securities are traded on local and international markets. This industry caused the stock market crash of 2008 and threatens the global economy as we speak. In fact, the betting game played by the banks called the derivatives market is currently estimated to be 20 times larger than the gross domestic product of the entire planet. We're talking about a quadrillion-dollar business. There was one journalist who actually wrote that he didn't even know that what a quadrillion was until he learned about the derivatives market. It's 1,000 trillion. Rather than slowing down, its sheer propensity for profit has led to a rampant growth of the industry in South Africa. The Banks Act makes it crystal clear that securitization falls outside the business of a bank. That they are breaching the Bank Act. It says in the Banks Act, it is outside the business of a bank to engage in securitization. I'm not kidding you. It's so clear. Yet they do it all the time. There's always a counter-argument, and my little counter-argument friend will say, but it doesn't happen in South Africa. Doesn't happen in South Africa. It's small, it's small. Scott Tata, it's small, it doesn't happen. Go back to sleep. It's widespread in this country. And the reason that the Banks Act changed it so it wasn't part of the business of a bank was also for greedy reasons. They did it because they wanted Edgar's and Woolworths. Don't quote me on these exact names. I'm sure Edgar's has got one. Not sure about Woolworths. ShopRite. Those kind of. They wanted to take their shop cards and securitize them. Because you see what Edgar's can then do is they can take all the credit that's owing, sell it to investors, and make their money up front. That's why you're starting to see these profits go up. Remember bottom line? Yes?
So, question on that.
Yeah.
If you're selling all these, securitizing and selling all these loans, securitization process,
Yes.
does that mean every month when we are making our home loan repayments, a certain chunk of that goes to the new owners of the securities?
The whole lot does.
The whole lot does?
Yes, the whole lot.
The bank cannot even keep a certain portion?
No, and I'm going to tell you why. In fact, I'll go into that now since you've asked the question. When a bank sells a loan into a securitization pool, it's called a true sale. They have to sell all of it together. So that entire thing has to go. You can't keep a bit. We have learned that sometimes what they can do is they can keep the interest portions. So either they sell the whole lot with the interest. So if you're paying 3 million on a 1 million rand loan, 3 million over 30 years, they can sell off the 3 million rand. Or they sell the million rand for 900,000, but they keep the interest. So there's, but they,
Why split it into two agreements then?
they'll do anything to make money. Whatever they can sell to the person on the other end. Remember, they've got to sell, they sell to what's called a special purpose vehicle and a third-party entity who then resells it again to either other special purpose entities, because they have to keep, it's like a Ponzi scheme, it's a pyramid scheme. You've got to take, if somebody defaults here, you've got to now find someone else to stick it here. And then, so you've got all these loans coming in and out. So essentially, they'll do whatever they can to make it attractive enough to sell to a third party. For example, what I believe they did to my loan was they made me jump through hoops to give me a AAA credit rating. So remind me later, well, I don't really want to go into it now, but we talk about how they rate these loans and how they get A rating, AAA ratings, B ratings, C ratings, etc. And then they sell the A ratings for different. So really what they do is it's really about how they manage the prospectus for the end of investor. It's about how to sell it. So that's essentially why. But the law states that you have to sell it. When you sell it outright. And you have no rights to that asset. Okay, this is going to be important. I'm going to come back to that a little bit just now as well.
Excuse me, when you sell off an asset, do they sell your deeds off as well?
The title deeds? No, but they do sell the rights to it. Let me get into securitization properly. I'm going to try and answer all those questions because this is a really, really complicated. It's as complicated as everything else I've done up until now and more so. Now, banks refuse to disclose the securitization process to the customer who has a lawful right to this information. Just to give you guys an idea, we've discovered now that it is very likely that banks are not even securitizing loans. And I'm not talking just home loans, car loans, credit cards, shop cards. They are even securitizing the future payments on your bank fees. Does anyone not know what I'm talking about here? It's very important. I want every single person to understand this. Please put up your hand if you're not 100% sure. Really, guys, there's one person. That's good enough for me. Okay, so essentially what is happening, if I can guarantee that I've got a stream of payments coming in every month, whether it's for 1 year, 5 years, it could be a Cell-C contract, anything that involves a monthly payment, I can calculate the entire value of those payments over the period, bundle it up, and then sell it to investors on the market. That's really how simple securitization is.
So you sell it for less than the total value so that they're getting a profit.
Yes, yeah, that's right. How that works is also very difficult to know because it's deadly secret. Guys, in this country, you can't find any information on it. It is so secret. Try and ask your bank if your loan has been securitized. And what do they say?
He runs away. Says I'm going to the toilet and doesn't come back.
They don't tell you. Why?
What's the difference between a session of the loan and what you're talking about?
Oh, that's such a great question. It's a beautiful question. Is there any relationship between the session of a loan and what I'm talking about? That's a beauty. There's a difference between a session and a sale. Essentially what he's saying is, in your original agreements, you sign an agreement that says, I agree to cede my loan. Now what I've got from my legal researchers is that what that means is you now have agreed in the original document for them to securitize. However, what they generally say is they give you permission to cede the loan, but there's a difference between a session. A session is used for guarantees in a loan. This is my understanding of it. If you cede a guarantee, so let's say for something, I put my house on the line. I can then now cede my house for one of you to take a loan on your behalf, but if you default on the loan, I lose my house because you defaulted. So the guarantee, the asset or the collateral has now been ceded. That works when loans are created. However, it doesn't talk about the sale. What's happening is they are taking those stream of repayments and they are selling it. So there's a big grey area with regards to the difference between the cession of an asset and the sale of an asset. And that's one of the things we're actually talking about in our court case. Yeah? Who then owns the original agreement? Good question. What's your question? I might be able to answer them together.
Who actually owns the house while you're repaying?
There we go. How did I know that would be the same question?
Yeah,
even when you paid it, you still don't own it.
okay, so you never own it, so
Yes, but they're selling the rights to an asset.
Money is right.
Exactly. Now you're getting it. Now we're starting to understand where we're at. Precisely. So what is actually, you're under the illusion, you're under house arrest in your own house. You're a glorified tenant. Now what happens is if these special purpose entities that have now own all these assets, remember they have to get the stream of income because the investors want their monthly revenue. They parted with a lot of money up front, and you could call it real money. In other words, it wasn't necessarily fake money, but because the investors are often banks or investors who borrowed money, which was created out of nothing, to invest in the derivatives market in the first place, most of it is. But they rely on this monthly stream. So all these pockets, all these bundles of loans that have been bundled together, rely on the monthly stream. If people start defaulting, that monthly stream dries up, there's a problem. Now, they do take insurance, which is the whole AIG thing, so they are actually insured. So if they don't pay, they actually get an insurance policy. So there's basically companies that have taken out a policy that says that if you don't pay off your loan, the investors are covered. Did you know that? It's called a default swap. For those of you who registered AIG, know about AIG and what happened to them. Now, what you're ending up with is you're ending up with a situation where the investor is completely protected against you defaulting. It's nonsense. So to answer the question, who owns your house? Theoretically, the special purpose vehicle to whom the rights were sold to owns your house.
But I had no agreement with that. I took the loan out. I didn't take the loan from those people. So what are they now? Why have they now got my loan?
Theoretically, you did take the loan. But this is where it becomes grey. Because who's your obligation to? Is your obligation to the bank you took the money from? Or is your obligation now to a third-party institution?
I had no agreement with it.
With the bank?
The third party. I have no agreement with that. I
No,
don't
no.
even know they exist.
Yes, you don't know. You don't even know who they are. This is where this is where it becomes a very grey area. Now, what the conventionalists will tell you is they'll say, and it's fair, that this is a wonderful way of refinancing. It's beautiful. The banks can take it off balance sheet because it means that they can now loan more money. That's why Standard Bank can say 75 billion in loans, because they didn't actually loan any of it. It actually came from these third parties. It provides much more. It gets more money in the economy and blah 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 blah, which is a fair comment. It's a fair statement because we're loaning from other people. However, the only issue, well, there's many issues, but predominantly is disclosure. If there was nothing wrong with it, why not tell us about it?
You might object.
Can I make a suggestion as to why? Let me give you a quote here. Let me give you a little bit of a suggestion. Okay. This is my research now, by the way. An article published by Decillion, Structured Corporate Finance, written by two experts, Eugene van der Berg and Annelie Jacobs, called The South African Securitisation Regulatory Developments, with reference to the South African Reserve Bank, state that transfer, in other words, the sale of the string of repayments into a securitisation scheme, transfer must totally divest the originator from all rights and obligations and from all risks and rewards.
But it doesn't.
So is it again?
Transfer must totally divest the originator from all rights and obligations and from all risks and rewards. Originator's bank. Let's call it the bank for now.
Security.
No, the
Selling
security, selling your loan. So, when a bank sells your loan, the bank must totally divest the bank from all rights and obligations of that loan and from all risks and rewards. Now, up until we started causing one hell of a hullabaloo about this, banks were still going into court and foreclosing, even when it had been sold. Go to look at the motion court roll now of the High Court. You'll see that so-and-so had a loan with SA Home Loans. Now it's with, you'll see, Changing Tides. You'll now see Standard Bank doesn't sue on those loans anymore or foreclose. It's Blue Granite 2 or Blue Granite 3. All these different entities are now suing in court because they've realized that the banks don't have the right to foreclose anymore.
And who are those people? Are they the investors then?
Yes, the third-party entity.
They're the third party now.
Yes,
Look after
who
the
want
interests.
exactly. So this is why they want to become very quiet. So their argument, yes. So a couple of questions.
The splitting of the agreement in the first place,
Yes,
then the one party sold off to
to cede the rights to the security. basically you sign an agreement that says the banks can do whatever they want. In fact, you guys might not know this, but if you read your agreement, first of all, it's only got one signature on it, proving that there's not a two-way agreement. It's only got one signature. The bank doesn't sign it, only you do. Okay, that's the first thing. Secondly, there is a clause in your agreement that says, should you wish to defend any foreclosure proceedings, you agree to pay all the court costs whether you win or lose. Okay, we're talking about a sick flippin' system here, guys. It's hectic. This is what's written. In fact, it says in those agreements that the banks can do anything they want. They basically stripped you of every possible right that you have. So to answer your question, they've actually ceded your right to your security. However, they haven't ceded it, they've sold it. And there's a difference. Okay.
Scott?
Yes.
How can we prove that?
Yeah.
When the note is sold to the SPV, okay, so now the new holder of that security, I imagine there must be some kind of contractual relationship now between the new owner of that stream of payments and the bank who is now acting as a collection agent effectively, because you still pay the bank each month. Do you know how that is structured?
No, and that's what you asked the question, how do we prove this? That's a really good question, because what happens is exactly what you just said. If the bank is now acting as a collection agent, they need to be registered with the collections agents board, blah, 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 blah. There's rules and laws they've got to comply with. Completely ignored. Completely. Remember, it's against the Bank Act for them to even engage in securitization in the first place. And we live in a world right now where things like FICA and phase and access to information and safety of information have never been higher